Welcome to the Retirement with and On Purpose podcast. I'm your host, Trevor Lawson, and this show is all about helping you not just reach retirement, but truly thrive in it. You've put in the work, now let's make sure you can enjoy every moment to the fullest. Today's topic was influenced by the recent crossing over of the mid-year point in the year. So now that over half of the year is behind us, I thought it could be a good time to reflect on the mid-year outlook for the market and the economy. And today's discussion will be heavily influenced by a recent publication from the Capital Group, their 2025 mid-year outlook. So I'll be referencing their outlook and kind of shaping our conversation today. The Capital Group is one of the longest standing investment companies and does a very good job with timely insights and educational pieces on their expectations for what lies ahead and ties in, historical data to help those decisions. So we'll be using this. In no way does this necessarily reflect my own beliefs, but I think they raise a lot of good data points worth our consideration and reflection. So let's jump in. One of their vice chairs, Jody Johnson at the Capital Group, was largely responsible for this article, so I'll be quoting her quite a bit today. She notes, "We're in the middle of a fundamental restructuring of the geopolitical order that we've known since the end of World War II, politically, militarily, and economically. At the moment, investors don't know how these events will play out, and that's why the financial markets are having a difficult time finding a clear direction. Volatility has really been the theme this year. If you think back to April, it felt like the bottom was falling out with the market going down. But then since then, we've seen a run up in the market. So volatility rose sharply in the first half of the year, she notes, as tariff-induced trade wars and real wars dampen the global outlook. This lack of clarity is affecting the decision of investors and company management alike. It's become much harder to determine where to invest, over what period, and what types of returns to expect." So where does that leave us? So we'll see over the course of the next few minutes kind of how the Capital Group is processing these events and how it's shaping their predictions for the rest of the year. So the economic outlook, higher uncertainty, lower growth. So the growth projections have been revised downward for a lot of the world. The GDP for the Capital Group, they initially had projected it to be around 3.2 for 2025. They've revised that down to 2.8. And then the U.S., they expected the U.S.'s economy to grow by 2.2% from a GDP perspective. They've revised that down to 1.8. What's driving that? Uncertainty. So many companies are hitting the pause button because they don't know what the rules are going to be a week, a month, or a year from now, Capital Group economist Daryl Spence explains. There's just so much uncertainty right now, again, driven by the tariff talk and a lot of back and forth with the current administration on what they're going to prioritize, maybe what they're not going to prioritize. And so a lot of companies are just hitting pause, and that pause button is going to potentially lead to a slower growth rate over the rest of the year, according to the Capital Group. So there's really 4 scenarios they project for a changing global landscape. Now, I'll go through these at a very high level, and then you're welcome to reference the article for more insights. So 1, a trade battlefront. So global trade and tariff measures spike in response to U.S. policy, but alliances remain intact. So that trade battlefront is one option. If that happens, then there's certain sectors such as defense, domestic businesses, automation that could benefit. Grand bargains, they call it. So opening positions prove flexible, diplomacy prevails, and alliances survive. That's another potential outcome from these tariffs and the changing global landscape. If that happens, you could see consumer discretionary, financials, global trade. Those sectors tend to benefit. A third outcome could be what they're dubbing assertive nationalism. So governments pursue nationalistic priorities in trade and security. If that happens, defense, consumer staples, real estate, and gold, those are all sectors that could hypothetically benefit. And then finally, great powers is a fourth outcome or fourth scenario. Large economies recognize spheres of influence and build competing trade blocs. This, again, could benefit defense, cyber and drone manufacturing, semiconductors. So in this article, they're painting a picture and laying out 4 different scenarios that could unfold as a result of this changing global landscape that we're encountering. So the good news is the markets recovered from trade uncertainty in Trump's first term. So if we go back to 2018, tariffs and China's slowdown hit markets in 2018. The S&P 500 was down 4.4%. 2019, though, stocks recovered and reached new highs. The S&P 500 that year was up 31.5%. So while history is no indication of future performance, if we look back at Trump's first go-round in office, the same sort of thing may have unfolded around tariffs and the market kind of reacted but then rebounded. We'll see if that proves to be true this time around, but it worked out during the first go-round in terms of the markets rebounding from that temporary pullback. A lot of people are really wondering when the Fed's going to rush in, so a lot of analysts are still projecting 2 interest rate cuts at some point this year. We'll see. As long as the labor markets, don't materially weaken, then you could see that the Feds continue to hold strong on not lowering rates. But as this article has alluded to, many companies are pressing pause and slowing down their hiring, which could in turn affect the job report coming out later this year. And that could spur the Feds to start lowering rates to kind of ignite economic activity again. We'll see. A couple other things here. When volatility is high, dividends can cushion the blow. So dividend growers have outpaced the broader market this year as a result of all the volatility. So now could be a time to revisit the dividends in your portfolio and see how, if at all, your portfolio is benefiting or lacking exposure to dividends, which have proven to be helpful at cushioning the blow during volatile times. Another positive is sharp market sell-offs can put leading companies on sale. So we saw a sharp market sell-off during COVID, and we saw another one in April of this year. But if we look at the consumer finance sector as an example, so the pre-COVID peak for consumer finance sector was January 22nd, 2020. The trough as a result of COVID was March 23rd, 2020. From peak to trough, the consumer finance sector dropped just shy of 55%. But 1 year from that bottom, it was up 145.6%. And then 5 years from that bottom, it is now up almost 300%. Companies like Discover, Capital One, American Express are all beneficiaries of this rebound in the consumer finance space. So sometimes these sharp market sell-offs can put companies that are otherwise trading at very high valuations at a discount and make them much more attractive as a potential entry point in starting to own shares of that company. A couple other themes. International. The international kind of sector is having a moment, and it's been long overdue. The U.S. kind of domestic markets have significantly outperformed international markets for the past couple years. But Europe is showing new catalysts and surprising innovation, according to the Capital Group. And then Japan's forging a path as a free trade powerhouse. So now's a time to, again, reevaluate your portfolio and see how, if at all, a rebalance or tilt towards more international exposure could benefit this changing global landscape and ultimately perhaps minimize the volatility in your portfolio by having a more diversified approach. Lastly, the other kind of asset class that's having a moment and that looks to be promising, according to the Capital Group, corporate bonds. So corporate bonds offered by very highly rated companies are showing continued resilience. So far this year, the international sector, corporate bonds are both performing better than they may have in years past and are helping an investor who maintains a diversified position and has exposure to these sectors. It's really helping, again, cushion their portfolio from the volatility that we've seen and squeeze out some yield and growth where possible. So I think one of the overarching takeaways for me when I read this, and I hope I can pass along to you, is the global landscape is without question undergoing a pretty significant change, and that change and its impact is still yet to be determined. But there are sectors of the market that are directly benefiting right now from this changing landscape, which is another reason why we preach on this podcast and why we will continue to preach the importance of maintaining a diversified portfolio. Over the past 2 years, the S&P 500 has really kind of had its moment, and you've seen the U.S. large cap sector really drive the market's performance, but that is changing. Again, international corporate bonds are regaining favor and doing well as of late. So it's important not to fall victim to the biases that we've talked about in previous episodes. Recency bias, as an example. Try not to let these things affect our portfolio positioning. Maintaining a diversified portfolio can really help cushion any future volatility we may see unfold as a result of a lot of the uncertainty still floating out there with Trump and his administration, and really help us be positioned for growth in sectors that may benefit from the changing global landscape. I hope you found this valuable. For more information, you're welcome to read the full mid-year outlook in the show notes. And until next time, stay well, and I'll look forward to being with you again soon. Take care. Thanks for tuning in to the Retirement with and On Purpose podcast. I hope you're walking away with new ideas and a fresh perspective on how to make the most of your retirement journey. And remember, retirement isn't the end. It's your time to live with purpose. Until next time, I'm Trevor Lawson. Here's to a fulfilling and thriving retirement.